Let's talk about stocks. Stocks vary from price to price in terms of range, but did you know that the world's most expensive stock is neither Apple, Microsoft, or even Amazon? Surprised? Well, I was too when I found out that the most expensive stock in the world is Berkshire Hathaway's, a company owned by the ever so smartest investor in the world, Warren Buffett. Yes, I'm pretty sure you've heard of him. The stock is so expensive that as of June 2021, it reached a whopping $415,000 for just a single stock. In fact, an average American's yearly salary is just one-eighth of that, an average of $51,000 per year. That's not surprising, consider that the stock price has increased by almost 8,000% since the company was founded. If you would have invested just $1,000 back then in Berkshire, you would have made around $10 million by 2014. Obviously, going back in time to invest isn't a possibility yet. But what we can do is learn how to make smart investments like Buffett. Today, we will be breaking down his two most important rules of investing. Hi, and welcome to Business Reactor, where we will be showing you the latest tips and tricks in the financial space as well as business and entrepreneurship. If you want success in your life and business, then you came to the right place. Because in this channel, we help you in getting ready for success. For more latest success tips from our videos, subscribe to our channel and click on that notification bell button. Let's get right into it. Now, the first rule of investing is to never lose money. I know that it sounds quite absurd, as if he's taking us as fools. But if you take a closer look, there are legit reasons why most people often lose money in the stock market. Your task is to simply avoid these traps by making sure you understand the rules of the stock game, which actually many investors take for granted. Take a glance at some of the companies, for example, that are traded in the market. They have a price tag because no one can afford it. They're then broken down into multiple stocks. But the real wonder here is if the company is actually worth $925 billion. Well, there isn't a big difference between the value and price of a stock. Let me explain. Prices jump up and down all the time, to the point where even the lightest negative reputation can reap sudden price drops. But not the value. That's because the value is the company's true worth. Like Apple, for example, they released the famous iPhone XR ending 2018, then sales weren't as high as the company projected. As a result, Apple received negative press, which drove the stock price down from $230 to $160 within just 3 months. Despite the huge dip in prices, did the company lose 30 or 40% of their value in that time period? Definitely not. Despite iPhone sales being down, the company continued to receive exponentially high profit in comparison to previous years, which is why stock price jumped back over to $200. Warren Buffett losing billions of dollars of his investment in Apple had the whole world shook. But did he care? Not at all. On top of that, he waited even further for the stock prices to dip so he can purchase more of it. Insane? Tell me about it. But that's because he understood the difference between price and value. Buffett once stated that risk comes from not knowing what you are doing. Warren dislikes taking the risk because he's well aware that you may lose money when you take it, violating his first rule of investing: never lose money, which is why he only invests in businesses that are undervalued. Risk is, of course, inevitable at one point, but you can decrease it to a minimum. Buffett encountered a business called PetroChina back in 2002. After checking their financial statements, it was clear that this company was worth around $100 billion. But when he looked at the stocks, the company was only valued at $30 billion. To Warren, this was a golden opportunity, and based on the political climate at the time, Buffett geared up and was ready for all prices to either rise or stay stable. Either way, he wasn't going to lose. Then he continued with his gut feeling and calculations, investing almost $500 million in this company. But the company didn't reach the $100 billion valuation as Buffett projected. In fact, it rose to a whopping $275 billion. Bet you weren't expecting that. Buffett sold his share and generated $3.6 billion in profit in return. I'd say that's a pretty darn good investment. After hearing all that, I hope you're finding the video interesting so far. If you do, don't forget to leave a like and comment down below your thoughts. We'd love to hear them. Alright, back to the video. We are finally clear about the first rule. So, what's the next rule? Well, as you've waited, the next rule of smart investing is, drumroll please, always remember rule number 1. Didn't see that coming, huh? Well, if you do your research and really do your research at the companies that Warren Buffett has invested in, you'll definitely be inclined to never forget this rule. That same rule he followed to earn his company the most expensive stock in the world and his title as one of the smartest investors ever. And that's it for today. If you're new to this channel, don't forget to subscribe and turn on your notifications for up-to-date videos on new trends and tips in the financial space, as well as business and entrepreneurship. Also, do leave a comment below if you have any thoughts and give a press on that like button. Thanks for watching, and I'll catch you in the next video.